Let's talk about the markets as a whole when you're looking at market cycles relative to economic cycles. Now, the way this chart works here is the dark blue is the market, and these are averages over time in the market, and then cycles with the economy, so economic cycles. And what you see here is both of them kind of go up together, but one, being the market, tends to peak before the economic cycle peaks. Now, you start seeing some cracks in the armor for the market before the peak here, and then the market starts coming down, and following, subsequently, you've got the economic cycle that's going down. When they hit bottom, though, there is literally about a 6-month lag between the market hitting the bottom and the economic cycle hitting the bottom. Now, this is kind of important here. And the reason is it goes back to the economic indicators. The economic indicators are forward-looking 6 to 9 months. So when they start turning positive, we're probably very close to the bottom of the market. And at that point, what do we want to do? We want to jump full into the market and make sure we're fully invested. Now, that being said, earlier this year, we made major changes with the portfolios. We've gone from growth stocks to value stocks. Why value stocks? Because value stocks stay more stable and they produce dividends. So if you have a market that's doing this, a growth stock is just going to do this on the way down. A value stock will go down, but not as much, but it'll also produce dividends, which keeps it a little more afloat. Now, we've also, this is something we don't like doing, but it really was the only safe haven, and that was we went to cash. So we took a portion of the portfolio, went to cash, because what was going on with bonds at the same time the equities were going down? Yeah. The bonds went down just about as much as the equities did. And that's why they're saying right now, the average person out there with a 60-40 portfolio, traditional 60-40, has had the worst year in decades because everything was going down. That which they thought was going to go up during these type markets didn't. It kind of worked the opposite direction. So we went to cash at that point with that. Now we've since gone back in, and if you have watching what's been going on, we went to cash up, we went back to equities low, now we're at a high again. So at this point, we're taking a look at it and say, well, I don't really want to go to cash again, if there's an alternative. Well, there is an alternative. It's called treasuries. When we went to cash, you might say, well, why didn't you do it then? Well, the treasury numbers were really bad back then, but they're looking kind of nice now at this point. So the yield on them is running much higher, and it's continually moving on an upscale right now. And that makes sense because inflation's going up and the Fed's raising rates. So as long as that's happening, you're going to see the treasuries go on an upward bias. So that's really our next move relative to the portfolio. So when you're looking at